Good afternoon. My name is Ian Port. I lead the content and creative teams here at StreetEasy, and I'm excited to welcome you to part 2 of StreetEasy's Home Buyer series. Today, we're going to focus on financing your NYC home purchase. So thank you for joining us, and I hope you're doing well wherever you're tuning in from. This week's events are designed to help you understand what it takes to buy a home in New York and give you some tips and advice for simplifying what can be a tricky process. Yesterday, we looked at the current market conditions in New York City and gave an overview of the typical home buying process. If you attended, hopefully you're feeling better informed about what that housing journey looks like. And if you didn't make it, we invite you to watch the recording of the webinar that will arrive in your email shortly. So today, we're going to focus on what's arguably the most intimidating and important part of the home buying process, understanding what a home really costs, what you can afford, and how to set up yourself financially for making that leap into homeownership. Today's experts will go into detail about what it takes to secure a mortgage, what to expect when you do, how to prepare your finances for buying, and even whether buying a home in NYC makes financial sense for you. First up, I'll welcome Tony Zhao, a residential mortgage banker at Investors Bank, who'll cover the basics of getting approved for a loan in NYC, interest rates, and do's and don'ts for when you're applying. Then I'll be joined by Amy Sallow, managing partner at Forest Hills Financial Group, who'll give some advice on preparing your finances to buy, understanding your budget, and NYC homeownership as an investment. I'm excited for all that. But before we dive in, I want to ask for your feedback. We work hard to make these events informative, concise, and continuously relevant for New Yorkers. After this one ends, you'll see a survey pop up on your screen. Please let us know how we did and what you'd like to see for these events in the future. Thank you. Now, I'd like to welcome Tony Zhao, a longtime residential mortgage broker at Investors Bank. Tony's a seasoned expert in mortgage financing in New York, and I'm excited for you all to hear his presentation. I'll be back after he wraps up. Tony, take it away.
Ian, thank you so much for having me, and it's a true honor to be here. So thank you very much. My name is Tony Zhao. I am a mortgage banker in New York City. I've been doing it for 22 years. And today I'm going to talk about what it takes to buy a home in New York City, because it can be extremely tricky and can be, like what Ian said, very, very intimidating. Now, the second you have the idea of wanting to purchase a home, I think first thing you should do is get something called a pre-approval, right? A pre-approval is a very important part of knowing what you can afford. The lender is going to give you an idea how much home you can purchase and how much you can buy. And that process should start 90 to 120 days prior to you starting to look for a home. I think one of the most important things that banks look at these days, because everything is so regulated, it's called your income, right? Income is very important because you have to show the bank you have the ability to make that mortgage payment. So the first thing you should do is, if you're a W-2 employee making wages, etc., you need to provide the last 2 years of your W-2s, usually 2019, 2020, along with one most recent pay stub. Now, that's going to give the banker the ability to show how much you can afford on the mortgage end. And like I said, it is very, very important for you to have that readily available. Now, if you are self-employed, now that's a little trickier, because in the last 2 years with COVID, I'm sure a lot of folks that are self-employed have had some challenges. So you will need to provide all of your tax returns for your self-employed and also your personal. Now, if you're self-employed, you need to show that your business has not suffered during 2020. So banks are usually going to ask for something called a profit and loss statement, along with your self-employed tax returns for 2020 and 2019. And what banks do is they actually take the average, if you're self-employed, of your last 2 years' income, and they take the average and make that into a monthly payment, or what you're earning on a monthly basis. Now, if you're submitting your 2020 W-2s and you've taken a little bit of a hit because you were furloughed or you didn't make as much because of COVID, we are going to ask for pay stubs, because your current pay stubs will give the bank a roadmap to what you're currently earning. So 2020 W-2s, 2019 W-2s, and 2 most recent pay stubs for that pre-approval. One important thing that banks look at because of the Patriot Act is bank statements. So when you're buying a home, usually you're putting down 10 to 20%. The banks want to know where funds for the down payment has come from, because they want to make sure that there's no illegitimate income, there's no illicit funds being used for a home purchase. So when a bank does a mortgage, they're going to look at every line item on your tax returns and your bank statements for the last 2 months before you purchase a home. Now, a lot of folks in New York will get a gift when they're buying a home, and that's completely okay. Just make sure that you line things up and have the ability to get something called a gift letter from the folks gifting the assets for the down payment to you. Remember, down payment and gifts can only come from a relative. So you can't get gifted funds for a home purchase from a friend, a non-relative, because they can come back and they can take that funds back from you, supposedly. So based on federal guidelines, if you're using money from a relative or from a gift, it must come from a blood relative. So banks, when they issue a pre-approval, they're going to pull your credit. And what they do is they take a look at all the debt that's on your credit report, credit card, student loan, car payments, and they're going to add what your new mortgage payment's going to be compared to what you're currently earning gross. And that's something called a debt to income ratio. Debt to income ratio should be under 50% of your gross income for the bank to approve you on the mortgage side. So if you're making $10,000 a month gross, all of your debt collectively should not exceed $5,000 a month. So that's why you need to get a pre-approval before you start looking for a home, because you want to find out if there's any issues with your credit, with your income, and with your assets. So that's why 90 to 100 days before you start looking for a home is extremely important on getting that pre-approval. Now, most banks will issue a pre-approval free of charge, and you can get up to 3 to 4 pre-approvals within 2 weeks and having your credit checked within 2 weeks without it dinging your credit score. So that's something that's very important for you to understand. Now, we're in New York City, and most of the properties that we see are going to be condos and they're going to be co-ops, which is, I would say, 60, 70% of what we see in New York City. Now, when I talk to a buyer, I actually tell them that 70% of getting a mortgage in New York City is about the building you're going to buy in. The rest is about you as a buyer. So here's 6 things to avoid when buying a home in a co-op or a condo. So if there's a co-op or a condo and there's one entity that owns more than 20%. So who can own more than 20%? It's usually the developer or it's usually the sponsor. If they own more than 20% in a building, usually a bank will possibly not lend in that building. And the reason for that is, if you own such a large percentage of one building and you as an owner fall into some kind of financial hardship, right? You're going to stop paying the maintenance, you're going to stop paying the porters, you're going to stop paying the property taxes on the building. And that's going to cause a financial strain on the entire building. And that could trickle down to you as a shareholder. So when banks look at buildings, they're going to ask for something called a condo or co-op questionnaire in the beginning of the process. And that's kind of the report card for the building. And within the first week of that process, that's when they're going to tell you, hey, can we lend in this building or can we not lend in the building? And that's very, very important because that's literally 70% of the process when buying a home in a condo or a co-op. Now, on that questionnaire, one of the big questions that we always ask is, does the building have an ongoing litigation? Litigations are usually tough on a building. Now, there are a lot of litigations in buildings in New York, but most of them are usually what you call a slip and fall. And if it's a slip and fall, it's a minor litigation. Banks usually will not have an issue with that because the insurance companies will cover those with litigations. The big litigations that banks tend to shy away from are the ones where there are issues with default of the building. Let's say a sponsor put up a brand new construction, as we see in New York City, there's tons of new construction, and they spent very little money into putting it up. And that causes an issue, let's say with a leak or there's structural damage down the road, and the sponsor or the owner sue the sponsor. And that's when you're going to have litigation in these type of projects where banks do not want to touch it. Space used for non-residential commercial space. Think about COVID and what's happening to the commercial businesses out there. There are a lot of folks not paying rent. And remember, in a condominium or a co-op, the commercial space is part of ownership in that building. They're contributing to the financials of the building that makes that corporation or that condo work. So if you have a co-op or a condo with commercial space over 35%, and all of a sudden they stop paying rent or they stop paying their part of their dues, that could have a detrimental effect on you as a shareholder in that building. So banks will place a huge emphasis on the percentage of commercial space in the building. It's a very big deal. Projects that are hotel, there's a few condotels where half of the building is condominiums, the other half are hotels. I would say 90% of the banks in New York City do not touch those buildings because they're afraid that one part of the building will, again, financially devastate the other part if they're not paying into their dues. Also, 50% of the units in a building that are investment properties. Now, you have to think about what's been happening with, renters, right? Folks in the last 12 months, many of them are not paying rent. And that's going to cause an adverse effect that could trickle down to you as a shareholder in a building. So banks will not touch a building if 50% or more of the units are investment properties. And remember, banks are going to issue or ask for that condo or co-op questionnaire within the first week of you going into contract. And that is going to tell the bank everything they need to know about the building. And as we know, there are a lot of land leases in New York City. So if the land lease is less than the term of the loan, banks usually will not touch it because they're afraid that if they have to renegotiate that lease or that underlying lease that the building sits on, and it's going to cost an astronomical amount of money, then that's going to affect all the shareholders of the building. So it's going to be part of that question on the questionnaire that the banks ask, and that's going to determine the eligibility if the banks will lend in that building. So I think these are very logical, but I do see folks, make a lot of these mistakes prior to buying a home. So if you're doing the process of pre-approval, if you're in contract to buy a home, these are all very, very important things to keep up with, right? Now, one secret that I'm going to tell you is that before closing, banks are going to run something called a soft credit check on your credit report. And it must be done 5 days before you close. They want to see if you've paid your debt on time. They want to see if you've taken out extra debt, because all this could cause an adverse effect on your credit report, on your credit score, and most importantly, something called your debt to income ratio. So obviously pay your bills on time, because if we repo credit before closing and it's late, you could have your loan denied last minute. Banks are going to ask for something called a verification of rent from either the management company you're renting from or proof from you with paychecks or stubs or certified checks that you've paid to the landlord, because we want to make sure that you show a continuity that you can pay your rent. Because if we're giving you so much money on a mortgage, we want to make sure you have the ability to, pay your rent. Keep working. Without your job, you have no income. And without income, you don't have the ability to pay a mortgage. So banks will do a verification of employment prior to closing, and just make sure that if you do have job changes, tell the mortgage loan officer right before closing. Save your pay stubs. We want to see that your income has not changed. And that's going to be a good indication when you show us your pay stub. And ask questions. Ask as many questions as possible, because there's so many things involved with buying a home in New York City. There's 4 to 5 attorneys on each transaction. There are real estate agents, there's title companies, and that lender or that mortgage loan officer is going to quarterback the entire deal. He or she will have the ability to answer any questions you have related to this very, very complex transaction. So like I was saying, do not make large purchases, especially on your credit card. Because remember, prior to us closing, we're going to repull that credit. And if we see that you bought a camper, or if you bought a new car, or if you took out a new credit card, the loan will need to be re-underwritten. And if it's a large enough debt, your loan could be declined because your debt to income ratio exceeds what is permitted by the federal government. So don't apply for a new credit card. Don't take out those large debts before closing. Moving money around, just remember, Patriot Act. The banks act as the financial police when you're buying a home. They want to make sure that the money being used for this financial transaction is not illicit. They want to make sure for money laundering purposes. So it's very important that you can source and document anything involving the purchase of this home. And definitely don't put cash in your home in your checking account, because obviously we don't know where that cash comes from. And if we see there's a cash infusion in your checking account, your loan could be denied. So closing costs in New York are extremely high. In my opinion, it's higher than anywhere in the country, right? You have 3 to 4% if it's anything but a co-op. And if it's a new development, closing costs could be 6 to 7% on the sales price, right? I don't think folks realize how much closing costs are. And remember, when you purchase a home, you cannot finance closing costs. Closing costs must be paid at closing with a certified check, and it cannot be financed. So when you're buying a home, aside from your 20% or your 10% down payment, please cushion 3 to 6% for closing costs, especially in New York, because once you go above that 1% mark, you have something called a mansion tax that could go from 1% to 2%. So when you start the process, you're going to build a team, and that team consists of mortgage folks, people that are attorneys, and they're going to be able to give you a good grasp of what closing costs are, but really figure 3 to 6% depending on the type of property you're buying. And, one thing I do get asked often is, where do you think rates are headed? And nobody has a crystal ball in front of them. But think about this, right? Folks are negotiating over $10,000, $20,000, $30,000 on a sales price or closing costs, etc. Prior to COVID, interest rates on a 30-year fixed were at 3.75 to 4%. Today, they're at 2.625. I've seen some banks with a 30-year fix at 2.5. This is not organic. What's happening is artificial. And the Federal Reserve are the ones that's keeping rates low because of monetary policies. In my opinion, and they've actually come out and said they're going to stop easing money. And what that means is we're going to slowly start to see rates head up. So think about if you're taking out a $500,000 mortgage at 2.5%, right? And versus a mortgage of $500,000 at 4%. That mortgage payment difference in interest rate is $300 to $500 depending on the loan amount you're taking out. And if you times that by 5 years, 10 years, 15 years, 30 years, that could be 5 to 6 figures. So in my opinion, in my 21 to 22 years of doing this, I've never seen rates under 3%. I've never seen a 30-year fixed at 2.5%. So if you have the opportunity to buy a home and lock in a low rate, I'm pretty certain that rates are going to go up. So I think it's very important for you to factor those in when you're negotiating sales prices, because rates, in my opinion, will go much higher in a short matter of time. And, you know, I think a lot of folks always say to me, and this is something that I hear often, especially with folks on Wall Street, believe it or not, they'll say, hey, you know, the feds have said that they're going to keep rates low. Well, remember, mortgage rates are not tied to the Fed fund rate. They're tied to different vehicles depending on the bank. Most of it is based on the 10-year Treasury bond and mortgage-backed securities. So that's being artificially, I guess, deflated, and it's being kept where it is because of what the Federal Reserve is doing. So if you listen and compare rates from the Fed fund rate to mortgage rates, those are two entirely different things. And what you have to think about is rates prior to COVID was at 4%. Right now, they're at 2.5 to 2.625, depending on the bank, depending on your credit score, depending on your scenario. So in my opinion, rates are not going to stay at these levels long, and I think they're going to change very soon. And I think that's it for me. Thank you so much for having me on, and I like to bring Ian back. Thank you so much.
All right, thank you, Tony. That was awesome. I hope you're all feeling much more informed about the home financing process here in New York. Tony, we'll see you shortly for the Q&A. I'm sure there'll be lots of questions for you. But now that we understand a bit more about what it takes to finance a home in New York, let's talk about how we can get there. I'm excited to welcome Amy Sallow, a managing partner at Forest Hills Financial Group, who's going to talk to us about preparing your personal finances for home buying. Amy, welcome.
Thank you, Ian. Thank you so much for having me.
Pleasure. Thank you for joining us. So let's start with the most basic question. What should buyers know about working with a financial planner? What does an expert like you offer buyers who are maybe looking at making a home purchase soon?
Sure. So the most important thing I think for someone considering a home purchase in terms of a financial advisor is that you're making one of the largest financial decisions you're going to make in your life, right? And while a lot of people feel that maybe they don't need to work with a financial advisor until they have substantial assets for that financial advisor to help them with, all of the financial decisions you make in your life are going to impact every other area of your financial life. So if you think of it like maybe when you're younger and healthier, it feels a little less important to go see the doctor. But by the time you're a little older and maybe you need a little more help or a few more visits, you want to already have a relationship established. So in terms of a home purchase, you're making this very large financial decision, potentially earlier in your life. And it would be great to have the ability to have already formed a relationship with someone who can help you think through from your side of the table all of the decisions you're going to make and how they're going to impact your life going forward.
Great. So what kinds of financial advice can a financial planner give? I mean, are we talking whole life finance advice or something specific to home buying, tax advice, all of the above?
Sure. It depends on the financial advisor and the financial planner, their philosophy, how they work. I think it's a best practice to interview and meet with a few. I read an article today actually that said 30% of people feel that the most important characteristic of their financial advisor is the trustworthiness. So it's in that relationship that you're going to find a fit and someone who you may work with for the rest of your life, really. So some financial advisors are primarily going to help you make investment decisions. Some financial planners or financial advisors are going to help you holistically with everything from risk management, insurance, saving strategies, debt management, and wealth or investment management. And then some people are very specialized. There's specific tax advisors or specific legal advisors that will help you depending on the complexity of your situation.
Great. And what would you say for buyers who maybe haven't considered getting a financial planner or aren't necessarily sure that they have enough assets to justify getting one? Is that something you really want to be at a certain level before you get to, or could it benefit anyone who's looking at buying a home in New York?
I think theoretically we're adding value, right? So working with a financial advisor before you make major life decisions, I think should provide the most value, right? And so I would encourage people to start early. And buying a home is an enormous financial decision. So making sure that you're set up in all of your other areas to withstand maybe unexpected events that may come into play, having sufficient liquidity and all of that, those are all things a financial advisor can help with.
So let's get into it. From a financial planning perspective, what's unique about buying a home in New York that buyers should think about?
Well, best case scenario, you're buying a home where your mortgage payment, principal, and the interest are going to fall somewhere around 15% of your gross income. I will tell you that in my 15 years working in New York, I've yet to meet a single client who could accomplish this, right? So it's very difficult in the New York real estate market to be, as we would say, optimal in terms of the amount of your income that is going towards that principal and interest. So that is the single greatest challenge we face, and it's really about planning and looking ahead to see what might come up, what expenses you may incur that you're not expecting, and how far you can push that based on your other assets that you have, liquidity, maybe other sources of income, to help make it possible for you to push the envelope a little bit on how much you're spending.
And that 15% rule or around there, what's the thinking behind that? Is that about, for keeping it within that realm? Is that about, saving for unforeseen circumstances or saving for retirement or something else? What's the rationale behind that?
That's a great question. There are a couple of things. First of all, things are going to go wrong for sure, right? Like if you Google your plan and reality images, right, you will see this lovely flat road and a cyclist, right? And then you'll see another infographic showing you the potholes and the rainstorms and that we don't know exactly what will go wrong for you, but we know that no one has a flat road, right? So keeping your principal and interest payment around 15%, and you are going to have to push it in New York City, is going to allow you to save into an emergency fund. It's going to allow you to save for the future. If we fast forward in time, if you think about maybe a 30-year mortgage, okay, 30 years from now, if all you have accomplished is to pay off your mortgage and you have not alongside that saved other money, then the only option you're going to have if you want to stop working is going to be to sell that precious home, right? So there's a lot going on at once, and we have to balance all of these future needs, a need for future income, potentially to be able to retire or stop working one day, along with the desire to buy a home today.
Right. That makes a lot of sense. Thank you. All right. Now, I'm sure a lot of people on this call are wondering, how should they figure out how much home they really can afford?
I think the place that I normally will start with clients is looking at that 15% number as a percent of your gross income, right? And you can use a simple mortgage calculator, which it's a calculator. It will give you an accurate answer on what that monthly payment is. Again, I'll use the example of a 30-year mortgage, and you'll see what that monthly payment is. And then you have to factor in all the extra costs that there will be, and those are going to depend on the property that you're looking at. So probably a realtor is going to be the member of your team that's going to help you determine exactly what other expenses there will be. And you should always buffer in some extra unexpected expenses, whether that is new appliances that you'll need or new furniture that you'll need or a repair that you didn't expect. All of these things are going to play in. So if you feel that you can make the monthly payments and you have the ability to save money for the future, then it's a balance, and it's a little bit more of an art than a science in New York City. I guess if you have been renting and you have a budget that you've been living by, you have some guidelines, right? And how far you can move from that and still be comfortable is really the question.
Got it. So you had mentioned, of course, the 15% number, but you also said that, that's a very hard number to achieve in New York City. Um, what percentage are you generally comfortable with, or like what do you see folks getting into that's a reasonable range above that 15%, since that is so hard to achieve in New York with the property prices here?
Right. So there is a maximum that the bank will lend you. Okay. So that's on the upper end. Generally, that's more than I'm comfortable with.
Mm-hmm.
So if the bank says that's too much, it's definitely too much, is what I would suggest. And then I would look at what you're able to save. So we can use the same number. 15% is a great number. 20% is even better of your gross income going into long-term savings vehicles. Okay. And that could be savings accounts. It could be investment accounts. It could be retirement accounts. It could be deferred compensation if you have that. It could be investment real estate if this is not a primary home purchase, right? So if you are able to save at that rate, then any amount over that 15% of your gross income going towards the mortgage and interest is fine, right? Because you're preparing and you have a backup that's equal to and growing the funds that you're putting towards the purchase.
Got it. So you're saying that 15 to 20% of savings should be kind of a prerequisite before going into buying a home, like saving for retirement, saving long-term savings, whatever the vehicle is. That's something you should be looking at before putting money toward a mortgage.
Yes. Now, that's optimal. Okay.
Right.
So
Okay.
so we're in pursuit of progress rather than perfection in these things. But if you think about it, if you're saving 15 to 20% of your gross income, and then you take the bulk of that out for your down payment, that's okay, because you're still in the habit of saving that amount. So you can begin to rebuild again after having used that money for a down payment. That down payment is going into an asset. Your real estate will be one of the assets that you own. And so there's no problem to divert those funds into the down payment. The more important thing is being able to continue to save after you've purchased that home. If in purchasing the home, you then have every last dollar going out to pay for that home, I promise you there will be something that goes wrong.
Okay, thank you. That's helpful. Of course, we know buying in New York is expensive. How would you suggest people think about the long-term costs of buying versus renting? In other markets, renting is sometimes portrayed as being a bad financial move because you're not building up equity. But I wonder if, given the cost of housing in New York, does it make sense for some people to look at renting long-term, or should buying be the goal, kind of no matter what your financial situation?
Sure. I think renting is a great option for many people. Again, you have to have the financial ability to continue to pay for that purchase and also save for the future. Now, there are a couple situations where I think renting is the best choice. As Tony mentioned earlier, there are closing costs, right? So if you were planning to buy a property and then maybe in a year or two move somewhere else, then renting is definitely going to be a better option, because if you take those closing costs and you spread them over 2 years with real estate fees, with the mortgage and interest, it's unlikely that you're going to come out financially ahead, right? I think a mortgage and a home purchase should be seen as a long-term project. It doesn't need to be 30 years, but certainly I think you should be looking, at a long-term decision, a long-term investment, so that you can recoup some of those initial costs that you had in purchasing over time. Real estate can be a great investment. It has high potential for increase to grow. It just, if on the flip side of that, your decision is premature or it's a little too aggressive, then you may find that you end up with high interest credit card debt or personal loans or that sort of thing, because you just were not sufficiently liquid. You just weren't quite ready to make that purchase.
How bad is it to borrow, if at all, how bad at all, to borrow from retirement funds for a down payment? Is that something folks should consider?
Sure. I think if you have money in your retirement accounts, there are rules around IRAs, around Roth IRAs, around 401ks as to how much you can borrow. With a 401k, you are going to have to pay that money back. So there's a little more risk. You can take a little more money out, but there's a little more risk because it is going to impact your cash flow. And in addition to that, if you leave your job, you may be in a tight spot needing to pay that back or pay tax on those funds that you've borrowed. So in an ideal world, you're saving money outside of retirement accounts where there are no real restrictions on how you use that money or when you use that money. So my first choice would be that you have savings in short-term vehicles, which would be bank accounts, would be low-risk investments, things that are intended to be for the short term. And you would only use your retirement accounts if maybe you hadn't thought you were going to buy and you had the bulk of your assets were in those retirement accounts, then certainly you could turn to those to get those funds.
Let's talk about some of the hidden costs of home ownership in New York City. You know, people are going to think about their mortgage payment now. That we're definitely going to think about those high closing costs. But what other costs should people consider and sort of take into account as they're thinking about making this leap?
It really is a very individual situation depending on the building, right? You are going to have common charges or maintenance fees, taxes. If you have a car, you have to think about where that car is going to stay if you're going to keep it. Also just improvements. You know, if you're moving into a space, most of the time there are things that maybe your furniture doesn't fit, or maybe you need new appliances, or there are just upgrades to be made. So I think those are things to consider. I also think Tony touched on this also on fixed mortgage rates. Rates are extremely low right now, and it can also be very appealing to people to take an even lower rate that might have a variable interest or some kind of balloon payment, and that can be difficult. Times can change, your income can change, your job can change, and your ability to get a mortgage can actually change over time. So if you have the ability to, especially if you're pushing the envelope a little bit on your budget, and you're concerned about the size of the mortgage, I think it can be a best practice to think about locking in a fixed rate so that isn't something that jumps out at you 5 years down the road.
Yeah, that makes sense. Generally, though, if folks are renting now and looking at buying, it's probably a good idea to just assume that they're going to be on the hook for quite a bit more potential monthly costs as an owner than as a renter, right? Like things come up, maintenance comes up, assessments come up, and that's something you're going to have to cover as a buyer versus having your sort of fixed rate payment. Am I right?
It may be higher, it may be lower, but it's going to be more layers for sure.
Got it.
Right, and so I definitely would sit down with the realtor and really get an understanding of what is involved in the building. You should have a team. You should have an attorney on your side. You should have your realtor. You're going to have your mortgage broker, mortgage banker, and a financial advisor. And I think if you have that team and everyone is weighing in on your behalf as your advocate to make sure that you've thought through all of these things, then that will be helpful.
Okay, last question. How should buyers prioritize saving for homeownership against other financial needs like, student loan repayment or retirement, other investments?
Yeah, so I love that question. There's two parts to it. The loan item I'm going to tackle differently from the investment item, right? So any money that you're putting away for a home purchase, other than the closing costs, you really are putting into an asset, okay? So that money that you're saving is then going to get dropped into that real estate. So that is savings, right? Any investments that you make, any money that goes into a bank account that does not come back out, right, is savings, and anything going into your retirement accounts is also considered saving for the future. So more liquid first, right? Bank accounts first, investments second. Retirement, I would consider limiting to maybe the match if you have a match from your company, just to keep yourself liquid so that you do have that money for a down payment. When it comes to student loans, I think this is very interesting. Really any loans, but we'll just stick with student loans for now. If you think about it, as you are paying any kind of debt, whether it's student loans, mortgage, but again, student loans, you're paying an interest rate on a declining balance. So over time, the amount of interest you're paying is going down because the balance of the debt is going down. When you're saving money on the other side of that, you are earning interest on an increasing balance. So sometimes people will look at it and say, well, if my student loan rate is 5% and my mortgage rate is 3%, I should rush to pay down my student debt and then rush to pay down my mortgage and then start to save after that. And I would counter that savings with the increasing balance and therefore increasing interest is a better place to put your money. You can always change your mind and take all that money out and pay off your student loan, or take all that money out and pay off your mortgage. But in general, keeping your own money and having access to those assets, I would prioritize, especially in the interest rate environment that we're in today.
That's very helpful. Thank you. All right. Well, this has been super informative, Amy. I really appreciate all your insights here. And I know it's hard to get specific on finances for a large group, but we appreciate it. At this point, I want to jump into questions from our audience. Let's bring Tony Zhao back to the screen, and we can go through some of the questions you all have submitted. All right. Hey, Tony. So our first question comes from Atika M, who asks, as a first-time buyer, is there any way I can purchase without 20%?
Yes, absolutely. Now, banks will lend you usually up to 95%, 90%, but anytime in the United States, when you put down less than 20%, you have to pay something called PMI, which is mortgage insurance. And the mortgage insurance companies are all third party. They're not connected to a bank, and it's like a separate insurance company. And their job is to ensure that, in the case that that buyer or that homeowner is late on the mortgage, the insurance company is going to jump in and cover any losses the bank may incur because the buyer put so little down. The most that you can put down, or the least you can put down under 20%, is a federal mandated loan amount, which is $865,000. So if you borrow up to $865,000, you can put down any amount under 20% once you hit that threshold. But remember, the mortgage insurance companies, or the PMI companies, which are all third party, they must approve of that PMI and the mortgage as well. But in short, yes, absolutely, we do and see that all the time when buyers put down less than 20%.
Great, but there is some limited availability in New York for inventory buildings that will allow below 20%, correct? Or below 25%. Not every building will allow. A lot of co-ops will require 20, 25%. Am I right about that?
I think in 22 years, I've seen 1 or 2 transactions where a buyer or a co-op will permit a buyer putting down less than 20%, because each co-op has something called bylaws, right? Which is the rules and regulation when that corporation was formed. And they will usually implement the rule that no buyer entering that corporation can put down less than 20%. The once or twice that I've seen it was when the sponsor sold their units that they owned. Now, if you buy into a sponsor-owned units, usually the buyer do not have to follow the bylaws of that entity or that building. But on condos, there is no such restriction. As long as the condo board gives you a waiver, which is another part of that process for the approval, then you may close with less than 20% down. But it is a very rare occurrence that you see less than 20% in a cooperative.
Okay, a similar question, slightly different, from Rashida S. How much money should be put down to get the best home loan?
I think usually it really depends on your credit score and your debt to income ratio. I can't speak on other banks, but usually on a jumbo loan, if you put down 10%, if you put down 15%, if you put down 20%, and you have a decent credit score and a good debt to income ratio, the score does not change. Now, on a Fannie Mae or Freddie Mac loan, which is a loan amount under $548,000, the less you put down, the higher the interest rates. Because remember, the Federal Reserve gives money based on risk. And if somebody puts down 20%, that's a very low risk for the banks and Fannie Mae and Freddie Mac. But if you put down 15%, that's a little bit of a higher risk. So that money comes at a deeper price. So if you're putting down 5%, if you're putting down 10% on a loan amount under 548,000, which is that threshold for Fannie Mae and Freddie Mac, then the rate does go up slightly. So I'll give you just a comparison. A regular 30-year fix for somebody with good credit, buying a single family home or a condo at 548,000 below, putting down 20% should be at about 2.625 to 2.75, depending on when rates are locked. If you're putting down 10%, that rate might jump a quarter of a point. So there's a huge disparity in pricing if you're putting down less than 20%. And also, you do have to pay PMI. And that could be from anywhere from 4 to 10 years on how long you have to pay that mortgage insurance for.
Got it. All right. Joe B wrote in and asked, a lot of New Yorkers see having a rental property as attractive, but what are some of the financial cautions and pitfalls there of owning a rental property in New York?
So when you buy an investment property, you have to put down a lot more than your 20%. Most banks require you to put down at least 30, sometimes 40%, depending on the type of property, right? There is no co-op investment property loans. So no banks in the United States will finance, well, one or two maybe out of the thousands of banks out there will finance an investment property co-op loan. But on a condo, multifamily, single family side, usually the rate is anywhere from 0.5% higher to 0.75% higher. And also, you do have to put a lot more down. And it's harder to qualify on an investment property loan when you're buying it, because the banks want to know that if your renter does not pay you rent, and remember, in New York City, we've seen folks not pay rent, and the rent regulation and the rent laws are very pro-renter. So you have a lot of mom and pops, you have a lot of just companies that have not collected rent in 16 months. So if you have an investment property, the banks want to make sure that you yourself have the capacity not only to support your own mortgage or your own rent, but you have the capacity income-wise to support that investment property. And that's why rates and terms are a little bit, less attractive on the investment property and rental property side.
Thank you. And Amy, I wonder if you have any thoughts on the wisdom of a rental property as an investment, one of those investment vehicles we talked about.
Yeah, I think it can be a great investment vehicle. I just, again, as Tony said, you can have vacancies. So financially, you want to be in a position where you can withstand a decent length of time if you have an issue with your tenant. And also, just from a diversification standpoint, there is always a time when people need to come up with money, when they need to come up with something. And so if all of your money is tied up in real estate, it may be that you just aren't lucky with timing when it is, when you do need those funds. So keeping yourself liquid in some areas, you certainly can have rental real estate, and just don't assume that it will always work, or every year will be a great year, or every tenant will be perfect.
Great, thank you. All right, I'd love to hear from both of you on this one. Ainsworth P wrote in and asking for some advice. Do you have any suggestions on how to improve my debt to income ratio?
Yeah, for me, I'll jump in. I think it is about the monthly payment, right? That is going towards servicing that debt. So in some cases, you can have a higher amount of debt, but because the term of that loan is longer, the payment is lower, and that will help you out, right? Because it is about the amount of money coming out of your income every month to service that debt that is going to be most important. So as you think about refinancing various debts, sometimes people get tied into what type of asset it is or what type of debt that you hold. And I like to think a little more clinically about it, that we're really looking at what that monthly payment is, what the long-term interest looks like, and the stability of that interest rate. And then if you can lower your monthly outlay, that should improve your debt to income ratio. And I think, as Tony said, I'll let him jump in here, you want to do that sooner rather than later, rather than right before the purchase.
Yeah, Amy, you're absolutely right. And, for a bank, they get their money from the Fed. So they follow these very rigid, strict guidelines. And one of the most important things that we look at is debt to income ratio. And Amy has said before that the banks are a little more aggressive, right? We'll go up to 45 to 50% of your gross debt to approve you for a mortgage. But should you allow that to happen? No, you shouldn't live way beyond your means. And, I think a good answer to this is knowing how much debt you have, knowing what's on your credit report. I often tell folks, myfico.com, Credit Karma, those apps, they're not actually telling you what your scores are. It's some algorithm, and it's just giving you a base model of what your credit should be. Because could you imagine if those folks pulled your credit every 7 days? I mean, it'd be in the gutters. One thing that most folks don't even realize is, I have clients that tell me, hey, Tony, I just looked at my credit report on my application, and this credit card that I have is paid off. I paid in full every single month when the bill's due. Well, what folks don't realize is the credit card companies do not report your balance on your credit report when your payment is due or when you pay it off. They report it on the date that you open the account. So let's say if you have a Master Visa card and you open it on the 15th of the month, that's actually when that credit bureau or that card company will report your balance to the credit bureaus. So you have folks paying off debt, let's say on the 20th of the month. Well, they're going to report what your balance was on the 15th of the month, which is when you open the account. It could have been 10 years ago. It could have been 5 years ago. And that's a trick to understand. The credit issuer must tell you as a consumer when and the date that report your balance to the credit bureaus. And that's a great way, because when we pull credit and we import your debt into that credit system and we put in what your income is, that's how we come up with that debt to income ratio. So if you understand when the credit company reports your balance to the credit bureaus, that's a great way so that when the banks look at your debt and look at your income, you know exactly how much debt you have versus what your income can be.
That's great. That's very helpful. Thank you. I want to follow up on something you said, Tony, which is that, the online apps like Credit Karma and things like that, are they giving you an approximation of your credit score, or how trustworthy are those? And should people expect their credit score when it's actually pulled to be different, substantially different? What should they expect?
I think it's some algorithm and it's a model of what their balance is versus what their debt to income ratio is. Because remember, your credit goes up or down based on the availability of debt that you have. So if you have a $10,000 credit card, right, that's your limit, and you're at 9,000 or above 60, 70%, you're going to lose points every single month. So I have folks that says, hey, you know what? I have a 0% on this. Well, you shouldn't max it out because that's going to hurt your credit. And in my experience, from what people have told me, what their app tells their credit is versus what we see on a commercial side, I usually see that there's a maybe 20-point difference on each and every bureau. Experian usually reports the high one, and that's the easiest app to obtain. So that's usually off. And remember, you have 3 credit scores. Banks will use the middle of the 3 because that gives them the most accuracy of what your credit debt looks like.
Got it. And 20% off, it's 20% lower usually?
Yeah, it's never higher. It's always
never higher, right? Yeah. Okay. All right. Let's switch gears. I want to get to a question from Yesenia B, who wrote in and asked, what first-time buyer financial assistance programs are available?
I do see buyer financial assistance, but they're really more on the state level. They're all more on the nonprofit level. And those are really to help folks in the underserved area, folks that, make under a certain amount. We're in New York City where most buyers have substantial assets, income. So the grants that the banks give are usually tied to geographic location. And those are usually called the Community Reinvestment Act. It's an act passed by Congress to help promote home ownership in low income areas, what they call low to moderate census tract areas. I do know that there are a lot of assistance programs with closing costs, down payment, like you said, on the state level and also on the nonprofit level. But on the bank side, they're usually based on geographic location and where the property is and where the buyer is looking to purchase.
Great. And Yesenia and anyone else interested in this subject, I'll say we have some helpful content on this on the Street Easy blog, a guide to the state programs and other programs available. There are a number of them. They're fairly detailed, as you can imagine. So you can find some info there at streeteasy.com/blog. Popular question here, Gregoria wants to know, as an overseas buyer, are there additional expenses or things to consider when applying for a mortgage in New York?
So if you think about where the money for regular mortgages come from, where they originate, right? It comes from the Federal Reserve, it comes from mortgage-backed securities. So they're really taxpayer based. So most of the cheap money that you see, which is the 30-year fix that we've been talking about, they're typically for taxpayers, folks that are based in the US with income in the US, assets in the US, and credit in the US. So the foreign seas buyers are what you call a foreign national loan. And the banks and the institutions that offer it are not getting money from taxpayers. They're not getting money from the Federal Reserve or mortgage-backed securities. They're doing it on a business class. They're doing it based on, and Amy will jump in to talk about, securities lending, right? So they're going to be mortgage-backed by private banks, and they're called foreign national loans. Now, they're not going to be as attractive. They're never long-term. They're usually short-term, like 5-year fixed, 7-year fixed, and the rates are substantially higher because if you cannot prove the ability to pay in the US, right, which is with income, tax returns, credit score, then you're not going to be able to have access to federally backed money. So there are a few banks in the New York State area, New York tri-state area that will do foreign national loans, but the terms are not going to be as attractive. And I don't know about cost, but I think the cost is that you're going to be paying a higher interest rate.
Mm-hmm. On the portfolio side, I think there are probably a few more options. So if you have assets in the U.S. In trust, then there are lending opportunities against those assets, and that's probably the best place to look first. Those rates are going to be attractive, probably more attractive than the bank rates, but they're usually not fixed rates. So you have to consider that in the amount that you're borrowing against your portfolio, the risk of your portfolio, et cetera.
All right, I think we have time for one more question, and this is one I think we can probably all relate to. Samantha S. wants to know, what if I really, really want a home that is a little more expensive than I can comfortably afford? Should I wait? Amy, what do you think?
I think if you can cover enough months, I'm just going to use the word enough because it's not specific advice, Samantha, but if you feel that you can cover enough months, if you have sufficient liquidity, if you have some savings, you have some money to fall back on if things just don't go as planned, then I think interest rates are very low right now. It's an attractive time to buy. I would get a few opinions. Use your team, lean on them, maybe talk to a few different financial advisors and see how you feel about that risk. It's a little more risk, but sometimes that is the step you have to take.
Yeah, and I completely agree with Amy because, I'm a little biased. I truly feel that rates are on the rise, right? And there's never going to be, in my opinion, an opportunity to get a rate under 3% because that's never happened in the history of mortgage lending and mortgage rates. So the longer you wait, the higher the rate's going to be and the higher your mortgage payments is going to be. But that's not to say, I get folks that ask, what can I qualify for? And when I look at their income, if they wanted to, they could take $1 million mortgage out, but their accessibility to down payment and closing costs is what hinders their process into buying a home. So I think it's really up to the individual. It's not a one piece fit all question. It's how much access do you have to funds down payment. And the most important thing that Amy has been trying to preach is reserves, because in a rainy day, you want to make sure that you have the capacity to dip into funds to pay for that mortgage, to pay for that maintenance, to pay for that taxes or the HOA. So you certainly don't want to get yourself in a jam because you overreached and bought a home you couldn't afford.
All right, good advice. Thank you both. Unfortunately, we are out of time. I hope everyone has learned something in this session and in our other event this week. Hope you all feel a bit more prepared to navigate the home buying process in New York City. If you're looking for more advice, guides, and research, I strongly recommend you visit the StreetEasy blog at streeteasy.com/blog. You'll find our latest market reports, detailed guides to buying, selling, renting, all aspects of homes in New York City, and a lot more. That's at streeteasy.com/blog. Lastly, please remember to tell us how we did through the survey that you'll see right after this webinar ends. We read and take your feedback into account, so thank you very much for leaving it. And thank you again to Tony and Amy, our awesome guests today. Really appreciate your great insights and detailed remarks. And thanks to you all for joining us and for leveraging StreetEasy in your New York City home search. Have a great week.